Being a genius at writing off your business expenses is exactly what is destroying your chances of buying a house. You spend all year working incredibly hard to build your business, and when tax season rolls around, you take advantage of every single legitimate tax deduction you can find. You write off your home office space, your laptop, your software subscriptions, and your camera equipment. You track every single mile you drive for work and deduct your health insurance premiums. By the time your accountant is done, your tax return looks like a masterpiece of financial efficiency. Let us say your business actually brought in $100,000 in gross revenue this year. But after applying $40,000 in completely legal tax deductions, your taxable net income drops to $60,000. You just saved a massive amount of money on your tax bill. But then you decide you want to stop renting and buy a home. You walk into a traditional bank, sit down with a loan officer, and hand over those tax returns. The loan officer looks at the paperwork and tells you that because your income is only $60,000, you barely qualify for a mortgage. They do not care that your business actually generated $100,000 in cash. They only care about the net number on that tax document. This is the ultimate self-employed paradox. The more tax efficient you are, the harder it becomes to qualify for a traditional mortgage. This is exactly where alternative lending solutions come into play. And it is a massive loophole that wealthy entrepreneurs use all the time. It is called a bank statement loan. Traditional lenders are completely obsessed with your tax returns. Bank statement lenders do not care about your tax returns at all. In fact, they do not even require them. Instead of looking at your heavily deducted net income, these lenders look at the actual cash flowing into your business bank accounts to determine your qualifying income. Let us break down exactly how this works, because it is a total game changer for freelancers, independent contractors, and business owners. When you apply for a bank statement loan, the lender is going to ask for your last 24 months of business bank statements. They will literally go through and calculate your average monthly deposits over that 2-year period. They understand that you have overhead to run your business, so they do not count every single dollar as pure profit. Instead, they apply a standard expense factor. This expense factor typically ranges from 25 to 50%, depending on your specific industry. If you run a high overhead business, they might use 50%. If you run a low overhead consulting business from your laptop, they might use 25%. The result of that calculation becomes your official qualifying income. Going back to our previous example, if you deposited that full $100,000 into your business account, the bank statement lender starts with that gross number. They apply their expense factor, and suddenly, your qualifying income is significantly higher than the $60,000 the traditional bank was looking at. This means you can actually get approved for the house you want. This brings us to your debt-to-income ratio, which is the magic metric every single lender uses to decide if you can afford a mortgage payment. Your debt-to-income ratio is simply the percentage of your gross monthly income that goes toward paying your monthly debts. Calculating this for self-employed people is notoriously complex because income fluctuates from month to month. The formula is straightforward. You take your total monthly debt payments, divide that by your gross monthly income, and multiply by 100 to get your percentage. For example, if your gross monthly income is $6,000 and your total monthly debt payments are $1,500, your debt-to-income ratio is 25%. Most conventional loans cap your maximum debt-to-income ratio at 43%. But non-QM lenders, the ones who issue these bank statement loans, are often much more flexible. Some of them will allow your debt-to-income ratio to go all the way up to 50%. And because they are using your actual bank deposits to calculate your income, your gross income number is higher, which naturally pushes your debt-to-income ratio down into the safe zone. Now, you cannot just walk into a broker office with a messy stack of bank statements and expect to get handed $500,000. You need to have your financial documentation perfectly organized. First, you need those 2 years of bank statements, and they need to be clean. Do not mix your personal grocery runs with your business account. You need to show a clear separation between business and personal finances. You will also need a year-to-date profit and loss statement. Sometimes lenders want this prepared by a professional, but often a clean one you generate yourself is enough. You also need to prove your business is a legitimate enterprise, so have your business license ready to go. Let us talk about the credit and cash requirements, because this is where the catch comes in. Bank statement loans carry a little more risk for the lender since they are not verifying income through the IRS. Because of that added risk, you need to bring a solid credit score to the table. You want to be sitting at a 620 at the absolute minimum, but realistically, if you want an interest rate that does not completely destroy your monthly budget, you need a score of 680 or higher. Pull your credit report right now. Dispute any weird errors immediately, and pay down your high credit card balances. You also need a significant amount of cash. Traditional loans might let you slide by with a 3 or 5% down payment. Bank statement loans usually require 10 to 20% down. Plus, they want to see cash reserves. Reserves are liquid assets sitting in your account after you pay your down payment and your closing costs. Lenders want to know that if your business hits a slow season, you are not going to default on the mortgage immediately. Usually, they want to see 2 to 6 months of mortgage payments sitting safely in a highly accessible savings account. And yes, we have to talk about the interest rates. The interest rate on a bank statement loan is going to be slightly higher than a traditional, conventional loan. You are paying a premium for the speed of the approval process, which usually only takes 7 to 10 days, and the extreme flexibility of not showing your tax returns. But for most self-employed people, paying a slightly higher rate is a completely worthwhile trade-off if it means actually getting the keys to a house. If you are a freelancer or business owner and you want to buy a house, here is your exact action plan. Step 1. Get your financial documents organized this week. Download every single bank statement from all your business accounts. Step 2. Calculate your own estimated qualifying income so you know what you are working with. Step 3. Figure out your debt-to-income ratio. Step 4. Start aggressively saving cash. You need that 10 to 20% down payment plus your reserve funds. Keep your money seasoned and stable, and avoid making massive random deposits into your account right before you apply. Step 5 is the most important. Do not go to a regular big box bank. They will just reject you, damage your credit with a hard pull, and waste your time. You need to specifically research non-QM lenders or find a mortgage broker who specializes in bank statement loans. A good broker will look at your specific business structure and know exactly which lender will accept your type of income. The entire financial system is rigged to reward people with standard corporate salaries and punish people who take the risk to build their own businesses. But you do not have to play by those standard rules. You just have to find the alternative lenders who actually understand how modern business works. Stop letting your massive tax deductions keep you renting forever. Leverage your actual cash flow and force the system to work for you. Thanks for watching. We look forward to bringing you more financial information and tools to help you live a better lifestyle. Visit payoffdebtpro.com for more. And don't forget to like and subscribe.